Sydney property was a star performer in 2015 and a lucrative earner for many real estate agents. But 2016 has turned into a horror year for McGrath Estate Agents. A downgrade in its profit forecast for the year saw its share plunge 25% today, just 4 months after McGrath listed to great fanfare. Fund manager Roger Montgomery has been following the company's fortunes. Roger Montgomery, welcome.
Thanks, Ticky.
Now, McGrath first. What are the lessons here, beyond the obvious, which I suppose is probably don't buy a real estate IPO at the top of the property market from a real estate agent?
Indeed. Well, actually, common sense isn't all that obvious. And what you have in an IPO, in any IPO, and something that requires caution immediately, is you have a very knowledgeable seller and a bunch of knowledgeable buyers. And that was certainly the case here.
Because this is it's not like a private equity or a fintech float that no one understands.
Indeed.
This was real bricks and mortar business.
When we looked at the numbers, when we looked at the prospectus, what we noticed was that some of the capital that was being raised was obviously going to the vendors. Some of it was going to the purchase of another or part of the McGrath property group. And what was remaining was supposedly going to be used for additional acquisitions. But there was an inherent, I guess, conflict there, because we could see that any other acquisitions that were going to move the needle in terms of the size of the group would require more capital than what was raised and what was left over. So we thought there was an inconsistency in what was being proposed in terms of growth and what was actually being, what could be funded from the capital that was raised.
In the meantime, looking forward, it's rather concerning what McGrath is saying about the market. You know, in Western Sydney, after all, New South Wales is their main base. Western Sydney, they're expecting 25 to 30% decline in listings, and they also talk about falling Chinese buyer demand in the northwest.
Yes, we were aware of a drop off of Chinese inquiry for properties in Melbourne. We thought there'd be no reason. We thought that was structural rather than geographic. And so we thought there was no reason to think that it wouldn't happen in Sydney. That's going to continue. People believe that in order for the property market to fall, you need pressure on sellers. You need either large job losses or you need rising interest rates, and that will pressure owners to sell their properties. But what that misses is that you can have properties decline simply because of a dearth of buyers. So if buyers pull their bids away from the market, then that forces anyone who does want to sell at a lower price. So prices can decline in the absence of broad unemployment or an increase in unemployment or increases in interest rates. I think that's going to continue. I think it's going to start with apartments. We've seen...
Well, the Reserve Bank was talking about their concerns there, weren't they?
And they're echoing the things that we've already said, and that is that if a developer is bringing a building out of the ground today, they're going to be selling into an oversupplied market. What that means is that they won't sell as many of their properties that they have for sale. That puts pressure on them to pay their loans back to the bank, and they're forced to discount their prices in order to get the properties sold. And that's what I think is going to happen.
Beyond that, Roger, we've then got the disruptors in the property market as well.
Yes, indeed. So REA Group and the likes of Domain. So at the moment, about $2.1 billion is spent marketing real estate in Australia in any year. That seems like an extraordinarily large number, but it's small when you think about the total value of all the properties sold. And what we know from that $6.1 billion is about 86% goes to real estate agents and only about 5% goes to REA Group. So REA, despite its size, despite its success, despite its historical growth, is still a disruptor, taking more share over time of that piece of pie that we call property marketing expenses.
So even a firm as sort of value conscious as McGrath, because they put a lot of effort into presentation, they're very high end, even they will be disrupted by the online forces.
Oh, absolutely. I suspect that it'll only be a matter of time before a vendor of a property sees that the prices of listings on REA continue to rise and they don't want to increase their total spend. So that will have to come from the real estate agents. quite frankly, real estate agents don't provide 86% of the value in the transaction and REA 5%. It's something that probably closer to 70% and a bit more for REA. But that means that their profits will go up at the expense of traditional real estate agents.
And I see McGrath mentioning today that there are other issues, including trying to get their IT sorted out. There seem to be other problems at McGrath. Do you think the value is there now, or do you think there's more concern going forward?
So some months ago we indicated that our valuation was about $1, and it listed, as you know, closer to $2. And so now but that was based on prospectus forecasts. So if the forecasts were met, they're not going to be met now, and so that means there's a step change down in the value in the future earnings of the company, and therefore in the valuation as well. So today's announcement is not only impacting detrimentally the share price, but also the intrinsic value of the business.
And dividends?
Well, look, dividends are a function of profits, and profits are going down, so one suspects that the forecast on dividends will be lowered as well.
Roger Montgomery, thank you very much for that analysis.
It's a pleasure, Ticky.